Hello, fellow Rebel Capitals. Hope you're well. We had a huge move in interest rates today, all along the curve, especially the 2-year, the 10-year. That's what I was most focused on. We're going to dive into it. But first and foremost, I want to figure out what on earth happened to trigger this huge move. Yeah, I'll keep saying that throughout the rest of the video. The huge move. There we go. All right, so let's go right over to the BLS because this is, I think, in part what triggered it. So right here, we had the non-farm payrolls. You guys know how important this is, at least for the market. I don't know if it tells us precisely what's happening with the labor market, but the stock market, the bond market for sure, obviously, is paying a lot of attention to this non-farm payroll. Now, the expectations were, in fact, let's go over to Market Watch. Where is the trusted calendar? And where did it go? I just had it. Oh, well, I can pull it up again. I just had it here. So going down to, oh, that's right, because I clicked on the BLS. That's what happened. All right, so bottom line. Expectations were for 125 and we got 139. So the market and, well, CNBC, the commentators, the financial analysts, we're all talking about how this is a great number. This is fantastic. And in fact, I heard some of the people in the Trump administration really spin this and say, well, this just proves how great of a job Donald Trump is doing because unemployment or the employment, the payroll numbers exceeded expectations. They don't tell you that the expectations were incredibly low. It's like, yeah, if you put the expectations are negative 500,000 and we come in at negative 400,000, yeah, that beat expectations, but doesn't necessarily mean that it's a good number. And when we have an economy of 350 million people, you have to have a certain amount of job growth just to maintain the number of jobs and therefore the aggregate demand. And I can assure you 139, that ain't cutting the mustard. So anything really below 200,000, you're in the red zone right there. And of course, we have to pay attention to the trend, and the trend is down. But today, it wasn't about the trend. It was simply about the fact that this exceeded expectations. So let's go back here and look at the move in the 10-year Treasury. Now we'll go over to CNBC. That's probably easiest. So up 11 basis points. And check out this chart. Any day now. So we're just humming right along here about 3.8. And then the non-farm payrolls come out and boom, an explosion higher. And then it just trends higher throughout the entire day. So you finish above 4.5%. Now, I don't think this tells the whole story. We got to go back 5-day chart. So you see right here, we get ADP, the payroll numbers, and that really was below expectations, to say the least. I mean, we were at 110 and we got 37,000. So it just plummets, as you would expect when it's all about growth and inflation expectations. Another thing that I've just been harping on, so I'm not going to beat a dead horse here. But what's really driving this? It's inflation, it's growth, it's inflation, it's growth. Nothing happened here with the deficits or the debt. Like nothing. This is not deficits or debt. This is strictly growth and inflation expectations. So anyway, we have this big move down here because of the ADP payrolls, and it might have that been right here as well. And then we had news right about here where Trump came out and said that he had a call with Xi Jinping and it went very well. So what happened? Interest rates go straight up. Why? Because it's all about growth. Because we've got this narrative that the only problem with our economy is just ready to rock and roll. But the only thing holding it back is just these tariffs. If we could somehow just get rid of these tariffs, the economy would just rocket higher. This is kind of the narrative right here, at least with a lot of the participants. So that's why you get this big bump right here, because now all of a sudden we've got growth and inflation declining. Now we've got growth expectations increasing slightly. But then you combine that with the turbocharged numbers today, that the only thing we care about, we didn't care about how low the expectations were to begin with. The only thing that was concerning was it was higher than expected. Higher than expected. Oh my gosh, it's higher than expected. Plus, Trump, we got the taco trade. Trump always changes his mind. I forgot what it was. Always chickens out. There you go. Always chickens out. So we've got this taco thing going on. So most likely Trump is going to get rid of the tariffs, or they're going to come down even further. We're going to have some sort of settlement, if you will, with China, the biggest player. And on top of that, payrolls are exceeding expectations. Oh my gosh. What are you going to do? You're going to, it's risk on. It's risk on. And then you see the 10-year Treasury being sold off. So I would imagine that this is a knee-jerk reaction. I think you're likely, I'm not saying that yields go down below 4% over the next couple of weeks, but I would not be surprised if they kind of trend down back to maybe where they started. Let's just say 4.4, 4.35 over the next week or so. But this is, regardless, this is a big move. And another thing that you'll see is it's not like we had this big move up and then we start kind of crashing back down. It kept going higher and higher and higher and higher pretty much throughout the day. So the 10-year moved 50 basis points. Let's go over to the 2-year. Here, another huge move. Same, up 11 basis points, up to 4.45%. So just a couple days ago, let's look at a 5-day chart. We were down, I'm at the lows here, we're down 3.84. So this is the marketplace telling you that, oh my gosh, again, the Trump tariffs are decreasing and we got great, higher than expected payroll numbers. Therefore, there's no way the Fed is going to cut. And I think that's what you're seeing here with the 2-year Treasury. Now, we'll have to see how this plays out. I think that this is going to trend down slowly over the next week, but we'll have to see. Now, one of the reasons I think it will trend down, because I think that once people digest the actual numbers over the weekend, they'll be like, wait a minute here. Maybe the non-farm payroll wasn't as good as we thought it was. If you look at the household survey, it started to drop again. So you guys know from watching my videos that we've had this huge discrepancy between the non-farm payroll, or the establishment survey, and the household survey. And the household is what really goes into, or is used to calculate the unemployment rate, if I'm not mistaken. And we had this huge delta, but then it started to get to the point where the household survey was getting back, or at least trending closer to the establishment survey, giving us the impression that that was the one that was off, if you will. But now Zero Hedge, we're going to go over to this in a moment, points out that it starts to plummet again, and you're seeing that gap get more extreme. So let's shoot over to that article. And right here, the unemployment rate was the result of the modest increase in the number of employed people from 7.166 million to 7.237 million, while the labor force declined by 600,000 from 171 million roughly to 170. More importantly, the disconnect between the household survey and the establishment survey is back, as the number of employed workers tumbled, I think that's a typo there, plunged by almost 700,000, even as payrolls reportedly rose. So this is the real head scratcher. You look at the household survey, and it's saying the number of employed workers fell by almost 700,000. But yet the establishment survey is telling us that we had overall increase of 139,000. Like, how do you square that circle? Like I I don't get it. So a lot, and I think this is very insightful on Zero Hedge's part. And I know a lot of the quote unquote experts are kind of asking this question. It's great. Okay, awesome. It exceeded expectations. But then when you look beneath the hood, you're kind of scratching your head and you're like, wait a minute, this just doesn't make sense. Let's go over some of their data points here. Number of jobless, less than 5 weeks, increased by 264,000. Doesn't seem that bullish. In May, the employment population ratio declined by 0.3. Okay, the number of people employed part-time for economic reasons at 4.6 changed little. Okay, not too much there. Labor force, we talked about that. Yeah, so the hourly earnings ticked up slightly, so that was good. It's all about healthcare. You see, healthcare added 62,000 jobs. Employment in the leisure and hospitality looks like plus 48,000. I listened to an interesting thesis today where the guy's point was it's going to be very hard for the United States to go into a recession because you have so many baby boomers getting to the age where they need a lot of medical attention, and that's expensive. That's really expensive. So this creates a lot of spending that you otherwise wouldn't have. And you see this with the healthcare. I mean, every single time I look at one of these reports, like the leading job creator is almost always healthcare, almost always healthcare. And that would make sense. Now, I don't know that this prevents the United States from going into a recession. That I would be a little suspicious. But it was an interesting theory, an interesting hypothesis. Last but not least, there was acute softness in both the breakdown between full and part-time, where the former tumbled by 623,000. Wait a minute here. Did I read that right? Was an acute softness in both the breakdown between full and part-time workers, where the former, as in full-time workers, tumbled by 623,000, and the latter increased by 33,000. Yeah, see, finally, the number, I know Zero Hedge likes to harp on this quite a bit. And I guess the MAGA people like to pay a lot of attention to this. I'm not saying that's right or wrong. It just kind of is what it is. So for them, finally, the number of native-born workers tumbled by 444,000, while foreign-born workers also dropped by 224, and easing back from the record set 2 months ago. Yeah, so I mean, every single thing that I'm reading when you kind of look beneath the hood is tumbled, plummeted, crashed, except for the establishment survey, which is up 139. It's just bizarre, isn't it? Except for wages. I guess wages were up slightly. I think the jury's out, is the bottom line. When you look at the ADP numbers from the other day that were horrific, you look at the initial claims, which wasn't terrible, but I mean, it's going in the wrong direction. That's for sure, up at 247,000. And we have this number today, which again, it's not terrible, but it's definitely not good. Even the headline number, and because expectations were so low. But then when you actually look at the details, you could see how, yeah, I don't know, this could be perceived as a little more bearish than bullish. And I think that's just being completely objective. So this is why I think if I had to just give you a quick prediction for what it's worth here, I think next week, I wouldn't be surprised to see rates kind of trickle back down to where they were to start, maybe the 10-year going back beneath 4.4, something like that. And probably the 2-year going back beneath 3.95. We'll have to see how it plays out. Maybe I'm wrong. Maybe I'm right. Now, there's another thing that I wanted to discuss, And this is what's happening with other central banks around the world. Because I know a lot of Americans, obviously, for obvious reasons, get hyper focused on the United States and the Federal Reserve, but I think that is too myopic. And I think if you just look at the Federal Reserve, you're like, oh, well, what's the problem? The economy is doing okay. It's not great. Stuck in the mud is what I've been calling it lately. But the Fed at 4.33, it's not like those rates are historically high. So seems like maybe they're in the sweet spot right now. It's kind of like a Goldilocks economy. But you completely ignore what's happening in the rest of the world where it's literally just falling apart. And when I mean falling apart, I'm talking about inflation expectations are crashing. And we just saw the ECB yesterday when they came out and dropped rates. Why? Because one of the main reasons was because their inflation metric, the main one that they focus on, dropped below 2%. Of course, that's their target because they're just like the Fed. And another thing that I'd like to point out is if you go back like 6 months, 9 months, every single other central bank, for the most part, in the developed world was very similar to the Fed. And they were higher for longer, higher for longer, higher for longer. They're all saying this, higher for longer, higher for longer. Maybe it was about a year ago, maybe not as recent as 6 months, but about a year ago, they're all saying, oh, no, inflation is sticky, and then even when the ECB started cutting rates, you remember that? They said, oh, well, here's what we're going to do. We're just every other meeting, we're going to drop by 25 basis points. And then you fast forward 8 months, 9 months, a year, and they're cutting it every single meeting, not every other meeting. So what changed? Well, what changed is the deterioration of the economy. And so it's forcing them to drop rates, and their inflation rate is just kind of a proxy for what's happening, where aggregate demand is decreasing and economic output is getting that right hook from Tyson. So, but it's not just the ECB. It's almost every single central bank. And so you just have to wonder, is the Fed going to continue to be this outlier forever? Maybe, but what's the probability of that? There are no certainties. There are only probabilities. And I don't know, maybe you would come to the conclusion that probability is high. But for me, I've got a bit of a different view. So what I wanted to point out is just something I just saw before we went live here. And this is the Central Bank of India. Let's see if we can pull up a story. It should be right in the news. Here we go. So we'll just go to CNBC, keep it consistent. India's central bank beats market expectations to deliver outsized rate cut of 50 basis points. India's central bank delivered an outsized rate cut to its benchmark policy, bringing it to 5.5%. This is the third straight cut since February and below the median estimates of 5.75. The RBI also changed its monetary policy stance to neutral from accommodative. And it's because I believe the inflation rate's coming down there. They're probably worried about the unemployment rate going up. I mean, very similar to what we're seeing in South Korea, what we're seeing in Australia, in New Zealand, in Canada, obviously in China. That goes without saying. And then, of course, in the Eurozone. So I wanted to bring that up just so you guys are aware of what's happening with global central banks, because I think that has to go into your analysis if you're trying to predict the probabilities of the Fed dropping more than, let's just say, twice or once or whatever the market is pricing in right now. You can't just look at the domestic economy. I think you've got to look outside, because usually they're tied at the hip. It's globally synchronized, as Snyder always says. And if you look at past cycles of interest rate hikes, of interest rate cuts, you see that, especially with these developed economies, they're usually kind of tied at the hip. And it's very rare that you have one of these outliers with the United States. So I guess what you have to decide is, at some point, we're likely going to revert to the mean, so to speak. So that's going to happen one of two ways. Either all these other central banks are going to raise their rates. They're going to stop cutting, and they're going to just magically start raising the rates because their economy just starts booming out of nowhere. And then they take rates back up to meet the Fed, or the Fed is going to start cutting dramatically to get more in line with the ECB and these other central banks. We'll have to see how this plays out. All right, guys. Now, I know a lot of you own gold. So this brings me to the sponsor that we've had for the last couple of months, which I'm very proud to say is Monetary Metals. I really like these guys. I'm good buddies with Keith, the owner over there, and they've been doing these lease programs for about the last 8 years or so. And I thought, I haven't taken a sponsor before, but when they presented this opportunity to me, I'm like, yeah, I think this probably makes a lot of sense, because a lot of the people that watch my videos, they own gold. Probably a lot of them own physical, and maybe not. I'm not saying 100%. I'm not saying anyone would want to put 100% with a leasing program, but maybe a portion of it, where instead of having to pay someone a storage fee, they can actually pay you, and you get paid in gold. So I've got an account with them, and I put about $40,000. So I got about $40,000 of gold in there, and I've had it for 2 or 3 months now, and it's working great. I've made some interest paid in gold. The user interface is pretty straightforward, but they've got great customer service. So if you're looking for an alternative for gold storage, one that actually pays you in gold, check it out. It's monetary-metals.com/gammon. And if you guys are kind of scratching your head saying, well, I don't get it, George, how on earth can someone pay me to store my gold? It seems like there's just way too much risk. And I totally get it. The model is a little complex, and you have to understand why jewelers, as an example, would want to hedge their gold inventory, because that's really kind of what it's all about. So what I did is an explainer video. Josh, go ahead and put that in the chat, and then put that in the description if you would. And so if you watch that explainer video, I think it'll make a lot more sense. And if you have any further questions, just give them a call. Tell them George sent you, and I'm sure they'll be happy to sit down and patiently answer all your questions to see if it's a good fit. All right, guys. On that bombshell, enjoy the rest of your afternoon. Enjoy the weekend. As always, make sure you're standing up for freedom, liberty, free market capitalism, and we'll see you in the next video.